All right, so let's dive into this post-election market analysis, shall we? You sent over this article from the Mimi versus James Substack, and it's really got me thinking about investment opportunities now that Trump is back in office,
It's a fascinating time for sure.
especially for small cap stocks, right?
Yeah.
That seems to be the hot topic.
Yeah, the article focuses on those. And it pulls in insights from two big names in finance, Tom Lee of Fundstrat and, Kathy Wood from ARK Invest.
Okay, so we've got those two perspectives to unpack, but first things first. The article suggests increasing exposure to small caps to like 30% during these initial 100 days of the new administration. They're calling it the honeymoon phase. That's a pretty bold move, isn't it?
It is. But the also does point out that both Lee and Wood have had some serious success with small caps in the past, especially back in 2021.
Okay, so they know what they're talking about, at least when it comes to this area. But why small caps now? What's driving this renewed interest?
Well, both Lee and Wood seem to be betting on deregulation as a major catalyst.
Huh. So the idea is that the Trump administration will loosen regulations, especially in sectors like tech and digital assets, and that'll create this sort of boom for small caps.
Exactly. And Wood, in particular, believes this could lead to a wave of innovation, particularly in areas that she feels have been stifled by overregulation.
Makes sense. But it's pretty broad. Are there any specific areas she's looking at?
She mentions genomics and multiomics. She seems to be really excited about the potential for breakthroughs there.
Those are some of her signature investment areas, right, with ARK Invest.
Exactly. But she also sees a lot of opportunity in the tech sector more broadly, particularly in areas like AI and automation.
So it's like a double whammy.
Hmm.
Deregulation fuels innovation, and that innovation drives growth, especially for small caps in those cutting-edge sectors.
That's the general idea.
Okay, so that's Wood's perspective. Now, what about Tom Lee? What's his take on this potential small cap surge?
Lee is also bullish on small caps, but he comes at it from a slightly different angle. He's more focused on the macroeconomic picture, specifically valuations and interest rates.
Okay, so break that down for me. What does he see happening there?
Well, he argues that small caps are currently undervalued compared to their large cap counterparts.
Undervalued. So in layman's terms, does that mean they're basically on sale right now?
Sort of. He's saying that based on certain metrics like the price to earnings ratio or PE ratio, small caps are trading at a lower price than they should be, given their earnings potential.
So there's a disconnect between their current price and their potential for future growth.
Exactly. And he sees that as an opportunity for investors.
Interesting. But valuations are only part of the equation, right? What about interest rates?
Right. He also believes that the Fed's battle against inflation is essentially over. He thinks real interest rates are too high right now and predicts they'll move closer to a neutral 3%.
And that would be good for small caps. How so?
Lower interest rates generally make it easier for companies to borrow money and invest in growth. And that can be especially beneficial for small companies that are looking to expand.
Okay, so we've got deregulation, undervaluation, and a potential shift in interest rates, all pointing towards a favorable environment for small caps. Does he give any specific predictions for how much growth we might see?
Well, he actually predicts the S&P 500 could hit 6,700 by the end of 2024.
Wow, that's a pretty significant jump from where it is now.
It is. He thinks that the second Trump term will be even more market-friendly than the first. He cites Trump's experience and the likelihood of a more stable cabinet this time around.
Okay, so he's definitely betting big on the Trump trade, so to speak. Anything else that stood out to you from Lee's analysis?
Yeah, he points to ARKK, Kathy Wood's innovation ETF.
How'd I?
He highlighted the recent surge in its volume after the election. He sees that as a potential leading indicator of growing investor confidence in small cap stocks, particularly in those tech and innovation-driven sectors.
So if you're looking for a gauge of how the small cap market is feeling, keep an eye on ARKK.
That's what he suggests.
Interesting. Now, let's shift gears a bit and dig deeper into Kathy Wood's perspective. She seems to be placing a lot of emphasis on tax cuts.
Yeah, she anticipates some pretty aggressive tax cuts, similar to what we saw during the Reagan era.
And she thinks that'll stimulate economic growth.
That's her view. She believes it could lead to more investment, more jobs, and ultimately more economic activity.
Okay, so it's a classic supply-side economics argument, but it's also a pretty controversial one, isn't it? Especially given the current levels of inequality.
Yeah, it's definitely a debate that's been going on for decades.
Right. And it's not really our place to take sides here. We're just trying to understand her perspective and what it might mean for the market.
Exactly.
So tax cuts are one piece of her puzzle. What else is she focusing on?
Well, she brought up a really intriguing idea,
Hmm.
the possibility of Elon Musk taking on a government role in the Trump administration.
Wow, that's a curveball. What kind of role does she envision him in?
The article doesn't get into specifics, but she seems to be suggesting that he could bring his expertise in technology, engineering, and data analysis to bear on some of the government's biggest challenges.
Interesting. So she sees him as someone who could drive innovation and efficiency in the public sector.
Exactly.
Okay, so she's got this focus on deregulation, tax cuts, and the potential for someone like Elon Musk to shake things up and govern it. It's a pretty bold vision, to say the least.
It is, but it's definitely aligned with her overall belief in the transformative power of technology.
And that seems to be a recurring theme here. Both Lee and Wood seem to be betting on a future where technology drives economic growth, and they see small-cap companies as being at the forefront of that wave.
Absolutely. And they both seem to believe that this new political landscape, with Trump back in office, could create a really favorable environment for that kind of growth to flourish.
It's a fascinating narrative, but it's also important to remember that these are just predictions. No one knows for sure what the future holds.
Exactly. We need to approach these ideas with a healthy dose of skepticism. The market can be unpredictable, and there are always risks involved.
Sure. And speaking of risks, I know the article also highlights some potential headwinds that could throw a wrench in these optimistic forecasts. Let's dive into those in part 2 as our deep dive.
It's easy to get caught up in all that optimism, but the article does point out some things that could go wrong.
Right, because even if everything seems to be lining up perfectly for small caps, there are always risks, right? So what are they saying could derail things?
Well, inflation's a big one.
Right, because even though Tom Lee seems to think that the Fed's done fighting inflation,
Right.
there's always a chance it could come back.
Exactly. And if that happens, the Fed might have to step in again and raise rates even higher than expected, and that could really hurt growth, especially for smaller companies.
Yeah, those smaller companies are usually more vulnerable to changes in interest rates.
Yeah, exactly.
So inflation's definitely something to watch out for.
It is.
Anything else they're worried about?
They also mentioned the outgoing Biden administration.
Oh, interesting.
Apparently, there's some talk that they might release some economic data that makes the economy look worse.
So it's like a last-minute data dump to try and make the incoming administration look bad.
Yeah, something like that.
But wouldn't that also spook investors?
It could, yeah. Especially if it contradicts all those positive projections we were just talking about.
Right, it could create this sense of uncertainty and make people hesitant to invest.
Exactly.
So we've got those risks to keep in mind, but let's say you're an investor who's feeling bullish on small caps after the election. What are some practical steps they can take to manage those risks while still trying to capitalize on the potential upside?
Well, diversification's always a good idea.
Right, don't put all your eggs in one basket.
Exactly.
But what does that look like in practice?
Well, it means spreading your investments across different asset classes,
Okay.
different sectors, even different geographic regions.
So not just stocks, but also bonds, maybe real estate.
Right. And within stocks,
Uh-huh.
you wouldn't want to put all your money in small caps.
Yeah.
You'd want to have a mix of large caps, mid caps, maybe some international stocks too.
So it's about creating a portfolio that can weather those ups and downs.
Exactly.
Hey, what about timing? Any advice on when to buy in?
Well, trying to time the market perfectly is really tough.
Yeah.
Most experts would say it's better to focus on time in the market, not timing the market.
So invest consistently over time.
Right. And one way to do that is through dollar cost averaging.
Dollar cost averaging. I've heard of that. Remind me how it works.
Basically, you invest a set amount of money at regular intervals,
Oh.
regardless of what the market's doing.
So if the market dips, you're buying more shares at a lower price.
Right.
And if it goes up, you're buying fewer shares at a higher price.
Exactly. And over time, it all averages out.
Makes sense. It's like a way to smooth out those market fluctuations.
It is. And it can help you avoid making emotional decisions.
Right, because it's so easy to get caught up in the hype or the fear and make impulsive moves.
Yeah, dollar cost averaging can help you stay disciplined and stick to your plan.
So we've got diversification and dollar cost averaging. Any other tips for staying sane in what could be a pretty wild market?
I think managing your expectations is really important.
What do you mean?
Well, this market is probably going to be volatile. There will be ups and downs.
Yeah.
Don't panic and sell everything at the first sign of trouble.
Ride it out.
Right, but also don't get too caught up in the hype and make rash decisions based on those short-term movements.
Stay focused on the long game.
Exactly. Investing is a marathon, not a sprint.
I love that analogy, and I'm to extend it a little bit. You wouldn't show up to run a marathon in flip-flops, would you?
Probably not.
You need the right equipment and the right training.
Yeah.
And I think it's the same with investing. You need to have a solid financial plan in place.
Absolutely.
You need to understand your risk tolerance, your goals, and have a strategy that can withstand those inevitable market storms.
Couldn't have said it better myself.
Now, I know we're still in the early days of this post-election market. Things are still taking shape.
Right.
What are some things investors should be watching closely in the coming weeks and months?
Well, the policies of the new administration are going to take time to actually be implemented.
Okay.
So we're not going to see their full impact right away.
Uh-huh.
There could be some surprises along the way, both good and bad.
Right, like those potential data releases we were talking about.
Exactly.
So it's a time for both opportunity and caution.
I think that's a great way to put it.
So stay informed, stay focused on your long-term goals, and don't be afraid to adapt as needed.
Absolutely.
Now, I know we also talked about Bitcoin in part 1, and I wanted to circle back to that.
Sure.
Because Tom Lee's prediction that it could hit 6 figures by the end of the year and even become a Treasury reserve asset is pretty mind-blowing.
It is.
So let's play that out for a minute. What would it mean for the world if a decentralized digital currency like Bitcoin really did become a mainstream reserve asset?
It would be a huge shift, that's for sure.
Right, like how would it affect traditional currencies? What about the role of central banks?
It's hard to say for sure.
Yeah.
It would definitely challenge the existing financial system.
And for investors, what are the potential implications?
Well, if Bitcoin were to become more widely accepted,
Uh-huh.
it could attract even more investment,
Okay.
which could push its price up even higher.
But it's also a very volatile asset.
It is, so there's always the risk of a big correction.
So it's a high-risk, high-reward kind of situation.
Exactly.
You really need to know what you're getting into. Now, how do you see Bitcoin fitting into this overall post-election investment landscape? Is it a separate thing, or is it connected to those trends we were discussing earlier?
Well, I think you have to see it as part of this broader trend toward digital assets and decentralized finance.
Okay.
There's this growing interest in these areas.
Right, it's like a whole new world of finance is emerging.
Exactly. And I think that trend is going to continue regardless of who's in the White House.
But Cathie Wood's emphasis on deregulation could really accelerate things, couldn't it?
It could. It'll be interesting to see how the new administration handles this whole digital asset space.
Right, will they embrace it or try to regulate it?
Exactly.
It's a big question.
It is. And for investors who are interested in this space, it's important to remember that it's still very new and evolving.
Lots of potential, but also lots of risk.
Exactly. Do your research, understand the technology, and invest responsibly.
Great advice. So we've covered a lot of ground here, from those optimistic predictions to the potential risks, from small caps to Bitcoin. What are some key takeaways for investors as they try to make sense of this post-election market?
Well, I think the biggest one is that market predictions are just that.
Predictions.
No one knows for sure what's going to happen.
Right.
So while it's good to listen to experts like Tom Lee and Cathie Wood,
Okay.
don't just blindly follow their advice.
Do your own homework.
Exactly. Think critically and make your own decisions based on your own situation and risk tolerance.
And stay informed.
Absolutely. The market's constantly changing.
Especially now with a new administration coming in.
Right. So keep an eye on those economic indicators, stay up to date on any policy changes, and be ready to adjust your strategy as needed.
And don't panic.
Exactly. Investing is a long-term game.
Focus on those long-term goals and don't let the short-term noise distract you.
And remember, you don't have to figure it all out on your own.
Right.
There are financial advisors out there who can help.
Great point. Okay, well, that wraps up part 2 of our deep dive.
It does.
We've covered a lot of ground, but there's still more to explore. In part 3, we'll get even more practical and talk about specific strategies for balancing those growth opportunities with protecting your hard-earned money in what could be a pretty volatile market.
Sounds good.
Welcome back for the final part of our deep dive. So in the last part, we talked about those potential risks in this post-election market. Now, how can investors actually try to balance those risks with the potential for growth, especially in a market that seems like it could be pretty volatile?
That's the big question, right? And there's no magic formula.
Of course not. But there have to be some strategies, right? Things investors can do to try to protect themselves while still taking advantage of those opportunities.
Right, and one of the most fundamental ones is diversification.
Okay, diversification. We hear that all the time. But in this context, what does it really mean?
Basically, it means not putting all your eggs in one basket.
Okay, pretty straightforward.
Yeah.
But how do you actually do that? Is it just about picking different stocks?
It's broader than that. You want to spread your investments across different types of assets, stocks, bonds, maybe even real estate or commodities.
So it's about having a mix of different things in your portfolio, not just relying on one particular asset or sector to do all the heavy lifting.
Exactly. Because if one area of the market takes a hit, the others can help cushion the blow.
Right, it's like a safety net.
Exactly. And you can even diversify within those different asset classes. Like within stocks, you might have large caps, mid caps, small caps, international stocks. You want to spread the risk around.
Okay, so diversification is step one. What else?
Another really helpful strategy, especially in a volatile market, is dollar cost averaging.
Oh yeah, we talked about that in the last part. But remind me how it works again.
Sure. Instead of trying to time the market perfectly, which is pretty much impossible, by the way, you invest a fixed amount of money at regular intervals.
Okay, so whether the market's up, down, or sideways, you just keep investing consistently.
Exactly.
And that way, if the market dips, you're buying more shares at a lower price.
Right. And if it surges, you're buying fewer shares at a higher price. But over time, it all averages out.
It's like a built-in smoothing mechanism.
It is. And it can really help to take the emotion out of investing, which is so important in a volatile market.
Because when the market's going crazy, it's easy to get swept up in the fear or the greed and make impulsive decisions.
Exactly. Dollar cost averaging helps you stay disciplined and stick to your plan.
Okay, so diversification, dollar cost averaging. What else can investors do to stay grounded in this potentially wild market?
I think managing your expectations is key.
What do you mean by that?
Just be prepared for some ups and downs. This market is probably going to be volatile, so don't panic and sell everything if things dip a bit.
Right, ride it out.
But also, don't get too caught up in the hype if things surge.
Stay focused on your long-term goals.
Exactly. Remember, investing is a marathon, not a sprint.
I love that analogy. It's such a good reminder to be patient and not get distracted by those short-term fluctuations. And to extend that analogy, I think it's also important to have the right equipment and training for that marathon.
Oh, I like that. What do you mean?
Well, in the context of investing, I think that means having a solid financial plan in place, understanding your risk tolerance, knowing your goals.
Absolutely. You need to know how much volatility you can comfortably handle.
Right. Because if you're constantly stressed out about every little market dip, you're not going to be able to stick with your plan.
Exactly. You need a plan that you can actually live with through thick and thin.
So it's not just about picking the right investments, it's about having that solid foundation.
It is. It's about being prepared mentally and financially for those inevitable market storms.
Right. Now, it's important to remember that we're still in the very early days of this post-election market.
Yeah, things are still unfolding.
So while we can look at those expert predictions and try to anticipate what might happen, we also need to be realistic. Things could change quickly.
Absolutely. The new administration's policies are going to take time to have an impact, and there could be surprises along the way.
So we need to stay informed, stay adaptable, and be prepared to adjust our strategies as needed.
Couldn't agree more.
And as always, if you're ever unsure about anything, don't hesitate to seek advice from a qualified financial advisor.
Right. They can help you personalize your strategy and make sure you're on the right track.
Great advice. Well, that brings us to the end of our deep dive into this post-election market analysis. We've covered a lot of ground.
We have.
From those optimistic predictions to those potential risks. From small caps to Bitcoin. From diversification to dollar cost averaging.
And hopefully our listeners feel a bit more equipped to navigate this new market landscape.
Absolutely. Remember, knowledge is power. The more you understand about the market, the better decisions you can make. So keep learning, keep exploring, and keep diving deep. Until next time.